Star 2.
Good afternoon, everybody. It's John Horwood at Richardson GMP. My apologies for the delay on this call. We had a little confusion with the conference provider, which we will undoubtedly take up with them later. Let me first of all thank you for joining me. I trust that your summer is going well, as it certainly is here. And a reminder, of course, that the views that we express on the conference call are my own. This call is primarily for family and friends. It has a long history. We started doing these calls back in 2002. You probably remember the tech wreck, when I felt there was a need to communicate personally and directly and to share my opinions with my clients, and we've been going with it ever since. The purpose of the call primarily is to deal with the bigger issues, the forest rather than the trees. We're not trying to compete with the daily newspapers or things like that. What we do for regulatory purposes, I prefer to quote from what I believe to be the best intelligent third-party sources of information, which I happen to agree with. So let me just start off with that and get back to the agenda. If we look at our second quarter results in our client portfolios, we find that as a general rule, our portfolios succeeded in Q2. They were up quite nicely. There were some challenges. Obviously, Brexit was one challenge, and we're going to talk about that shortly. The flip side was that we had a significant recovery in resources and precious metals, which were dramatically oversold in 2015 and in prior years. So while we're not particularly exposed to those more volatile areas, they certainly did help the indexes. But the key issues around the second quarter, obviously, the concerns over US politics and Brexit. I have enclosed in the package a couple of, I think, useful articles on Brexit from The Economist, who I think these are very, very interesting background articles. And I think if any of the pundits or the people that were raising Cain over Brexit had bothered to do their history or their subject matter research, I think they would have realized that the outcome, the prescribed outcome, was highly likely. I know I was born in England, I still have family there, and the moment you move away from London and into England proper, you find there's a significant antagonism towards the EEC, and particularly the massive number of bureaucratic rules. So really, a Brexit vote should not be a surprise. And if you read the Economist essay on European unity, you're going to realize that this is really just a part of a long unfolding saga rather than a one-off historical event. This will lead, I'm sure, to changes in the European system, and hopefully there'll be healthy changes because there are some lessons that need to be learned. That doesn't mean that it's not, the EU isn't a very, very successful organization. It's certainly created a unified, peaceful Europe, which hadn't been seen for centuries before, so we're very, very thankful for that. So expect a little bit more volatility from Brexit as we go forward. Although I think the next 6 months we'll see volatility from a different source, probably from the US presidential elections. Wouldn't be at all surprised on that. The good news is we've ducked the Brexit volatility in our portfolios and have outperformed pretty well. Let me just chat about the outlook for Q3, Q4, and going forward. The big issues that we discuss here every quarter really haven't changed. We live in a world where free trade is being marginalized and challenged. We have significant state intervention. We've seen this ever since 2008, 2009, where central bankers have taken the levers of the economy, flooded it with money, kept interest rates artificially low, and yet they've been unable to produce economic growth or any measure of inflation. So that background said, there's no real change there. This is the greatest monetary experiment of all time. I think it's unlikely to lead to economic growth, unfortunately. There are other significant impacts. Obviously, the impact of technology is a complete game changer. I don't think sometimes we realize what impact that has on us every day, but it's massive, and it is truly changing the world. If we try to look at the outlook going forward, we need to think very, very closely about where we are in the cycle. So we are at the tail end of an extremely long bull market. Interest rates in some places are actually negative. They're extremely low. So it's highly improbable that we'll see any kind of rates of return out of the bond market. And if we don't get significant economic growth, then earnings growth is going to be very, very difficult. And so we're not going to see great big returns out of the stock market. Now, the good news is that we're not relying on the traditional indexes for our portfolio returns. And I just refer you to one of the articles that I sent out in invitation, talking about how the big boys do it. This is something that we've been working on here for more than a decade now. The traditional asset allocators would have you invested in something like a 40-60 or a 60-40 split between publicly traded stocks and bonds, which has produced very, very poor returns over the last decade. You're often looking at 2, 3, 4%, and that's actually the projection for many pension funds over the next decade. I don't know about you, but I'm not all that excited about the prospect of a 4% return. So about 10 years ago, we started moving to the other model that we see on these charts, which is basically the endowment model, where I guess the best minds and the best investors have really changed the game. And you can see the significant changes. You can see very, very small allocations to domestic equities, more to foreign, but the key numbers here are private equity, absolute return, and real assets. And I think you'll recognize in your portfolios a significant proportion of these asset classes. The reason we're doing this is because we believe that the rates of return on these things are higher, and certainly our portfolios have proved it out quite nicely. Our allocation to private equity, going back to as far back as 2004, is paying off now, and we're seeing in some funds 8%, in other funds double-digit returns, well above indexes and with very, very low volatility. Similarly with alternative strategies, aka hedge funds, lending funds, credit funds, we're seeing much, much higher returns, and that's what we're looking for, and I'm very, very happy that we've done that. So we're following best practice as far as we possibly can. Obviously, there are limitations. Each client portfolio and risk objectives are different, and so a different mix of assets is required. Tax situations and tax rates vary, and so that also has to be reflected in portfolios. Let me just talk now about some of the new initiatives that have really benefited us over the last couple of years and will continue heading up into the future. So if we look at our specialty lending, if we look at our best 365 Tier 1 component, and our Bloom Burton structured lending funds, which are a significant holding in many of the client portfolios on this call. You're looking in the range of probably between 8% and 15% a year in a world where interest rates are 1 or 2. Been very, very successful. Similarly with Canso, Corporate Value, which is a corporate bond fund. We do have another opportunity that will be coming down the pipe and will be introduced to you over the course of the next quarter or so, called Cortland Credit. With Cortland, you're looking at, we believe, 5 to 6% returns with very, very low volatility. In fact, this fund currently has a Sharpe ratio of, I think, 16 or 17. Now, the Sharpe ratio is the measurement of return divided by risk. A really excellent investment has a Sharpe ratio above 1. Very, very rarely see a Sharpe ratio over 3. Current Sharpe ratio on this thing is about 16. With a yield of 5.5%, that makes it extremely attractive. We've been researching it. We've been testing it for several years now, and we're comfortable now introducing it to all of our clients. So you're going to see that. The other thing that I guess the other development that we've been aggressively moving towards now are index accelerators. So many investors really like the indexes. Personally, I don't. I don't think there's a great value add or a great brain in the accelerators, but there are specialty products called accelerators where investors can get something like 1.5 to 2 times the index return. And those, I find those very, very attractive in some situations, in some circumstances. So don't be surprised if they show up on the books over the course of the next little while, or at least get introduced to you. And I guess the last thing that's obviously important this time of the year is taxes. Taxes are always mission critical here. We spend our summers looking at client tax returns. In fact, looking at my own tax return. The general results, I would say, is that our clients are paying taxes that are probably half the rack rate. It's very difficult to generalize. Every client and every situation is unique and special, but for general guidance, there's a significant tax advantage to our strategies, and that's by design. That's the biggest cost to the portfolio. And when we now see marginal tax rates for individuals above 50%, this is a major, major problem and a major concern. When I was a kid, they called that socialism. When the state tax starts taking more than half of our rates of return, then that's seriously problematic, and we have to work on that. So our thesis here is to find unique investments that are not available in retail stores, aka the traditional bank-owned investment advisory firms or investment managers. We're looking for special. We have a unique value proposition because we can do smaller investment pools. Our most successful investment pools are often only client assets under $10 million. Clearly, these don't have scale for the major financial institutions, but we can make them work for us and work for our clients, and we have been doing for quite a number of years. So we would expect that we will be able to continue to outperform on a very, very long-term basis. Expect lower risk than the market, aka lower volatility, and obviously a better tax outcome. I have a couple of research reports that I couldn't share with you. They are proprietary, and we pay a lot of money for them. I really don't want them out on the internet. But if you're interested in some additional reading, some additional information on how we're going to get to the returns and the way the analysts view the market, then I'd be very, very happy to share them with you one-on-one. Simply email me, and I'll send them out if I think it's appropriate. Otherwise, we're going to enjoy the summer. We have already started it, but we will be around for the summer to take your calls, to have meetings, and to chat about your investment portfolios. I will be away in September. Rebecca and I are going to walk the Camino in Spain for at least a couple of weeks, but we have a full team of people here to guide you and advise you on investment portfolios. So let me just sign off by thanking you for your trust today, thanking you for your confidence. It's valued and it will be honored always. Wishing you a wonderful summer, whether it's in the city, in the cottage, or on holidays. Signing off. We covered your feedback. Let me know if there's anything at all that we can do for you. In the meantime, adios. Sayonara. Thank you.